All right, for more on the markets right now, let's bring in Barry Knapp. He is managing partner at Ironsides Macroeconomics, and Brenda Vangello, who is chief investment officer at Sandhill Global Advisors, also a CNBC contributor. And Barry, I'm going to start with you because what we've seen with these inflation numbers, what Larry Fink said today, what Stephen Mnuchin said today, all of them saying they think the Fed's going to have to raise rates sooner rather than later. How about you? I think you agree with that, too.
Well,
or not
sure,
raise rates, I should
yes.
say. Let's say start shrinking the assets that they're buying. Same
right,
thing.
That's how, that was what I was actually how I was going to respond is yes, unequivocally, and you could include your friend Rick Reeder, my friend as well, in there. He tweeted about that last night and talked about how the mortgage purchases in particular are creating a dynamic. We've got house prices rising faster than they were in 05, 06. The correlation of all the various cities is super high, implying that this is really being influenced by macro factors like the Fed purchases. They should not be supplying this level of accommodation into the market at this point in time, for sure. And I never expected Powell to make that announcement at the Humphrey Hawkins testimony today. So S&Ps fell 15 yesterday. They're up 16 today, sort of offsetting that risk. But 2 weeks from today is the next Fed meeting, and there's going to be an even more heated discussion about paring back those asset purchases. I think they really need to do that for the broader health of the market because they are just suppressing volatility in such a way that, as Rick Santelli implied, means that you're going to have a bigger reaction when they end this. And the biggest reactions last cycle when they ended their various QE programs came when they were buying mortgages hand over fist. So this is an increasing risk that they need to start walking back from.
And Brenda, your biggest concern is that right now there are a lot of people who are investing today who've never lived through a cycle where rates are rising and where you actually see inflation picking up at the same time. How should people prepare for that?
Yes, I mean, it's something that, most investors today really have never invested through an environment like that. And so that's what certainly keeps me up at night, thinking about how we're going to muddle through this. And I think we could expect to see certainly a pickup in volatility in the market in the second half of this year as we go through these environments where the Fed likely signals that they're going to start tapering, perhaps faster than what the market expects. And when we really learn what true inflation numbers are, after we get through this period where there are these transitory factors that have increased and those start to come down, but what are you left with? Are we left with a higher inflationary environment? I think we probably are. So I think the market is likely to be quite volatile as investors really try to figure out how they should be positioned. But I think what we're doing is, sticking with companies that really have pricing power. We have an overweight in commodities as well. We think there's great supply-demand story there across many parts of that complex. But in addition to that, it has been a good inflationary hedge. And we're staying cautious when it comes to bonds. I mean, that I think is the biggest head scratcher for us has been what we've seen in the reaction in bonds with the 10-year being as low as it is. We just don't think it's sustainable over the longer term here.
Shepard Smith here. Thanks for watching CNBC on YouTube.